when you are using net margin methods. If you use transactional methods, these would not have significant impact on you. Difference in financial years. Now, lot of companies' financial years are June. Some of them have December. So what do you really do when the financial year is not matching? Are you allowed to make adjustment for that, or do you reject the company, or you accept the company? What do we really do? Is there one answer? I would say no. This would really depend on the situation, the industry, the transaction. If there is a transaction or industry which is not dependent on a particular financial year, or if it evens out in a 3-year or 5-year cycle, whether it is April-March, or whether it is Jan-December, how would that really differ? But if something, say, dependent on aluminium prices fluctuate a lot. 6 months they are on good high and 6 months they are on absolute low. So in those cases, even a 3-month gap may make a difference. So the law says you have to use the data for the same period. Now, if it does not impact my prices, I may use it, but the TPO may reject it.
So on whom the burden is to prove that it affects or not?
In fact, if you followed all the recent decisions where they have all been anti-SSE, where large size companies or maybe hugely profit-making companies were rejected by a lot of tribunals saying that they skew the averages or they are super profit companies. But the tribunals have now said, including Mumbai Tribunal, that these cannot be rejected unless you demonstrate that there was something extraordinary which now compels you not to use it. So your FAR analysis, your benchmarking with respect to each company becomes the key. The terms, the industry cycle, all this becomes the key.
And suppose the data of December is available, but I have the quarterly results and audited quarterly results. So is it possible to make adjustment, like add the figure of one quarter and deduct, and then arrive at that thing?
Certainly. Nothing stops you from doing it. And in fact, it will be more advisable to do that reduce one quarter and add one quarter. But you need to make sure that when you do it, your accounting policies for quarterly results are the same as accounting policies for annual results. If there is a difference, probably you need to adjust for that.
And any judicial trend is there on this particular issue, whether difference in financial year is allowed or not?
There have been a couple of decisions where they have accepted it, and there have been a couple of decisions where they have rejected it also. So it's not a settled law that you can use or you cannot use, but strictly speaking, the law says for the period, or the documentation should be contemporaneous, data should be for the same period.
Excuse me, this revision of return, how many is done?
Interesting question. It really depends on.
Extra time.
Sorry?
It will extra time to the research.
Certainly, it does give you. So, you could look at that in a very sensitive case or where you feel a high exposure, not just on account of the addition, but the subsequent penalties. I am just giving you an example of what happened in one of our cases was that the data actually significantly differed, and this was in PNMM when the search results carried out subsequently were different, showed a different or adverse result for the client, where the client was wanting to revise the return, and we recommended them not to revise the return, because what would have happened is if they would have revised the return by themselves, they would have offered equal amount of adjustment. A TPO could not have done worse. So what you are trying to basically save is interest and penalties, and we explained to them of how penalty could not be levied in their case. So the exposure account was only on account of interest. So you may need to keep these things in mind, while advising your clients on this.
In case of gold jewelry company, how to daily quotation changes? How are you?
In fact, in those cases, you would mostly rely on cups. So, when did you do the transaction? Did you document your market price prevailing then? There.
What evidence you have?
So that is documentation, maintaining the evidence of the analysis or the due diligence that you did while fixing the price.
Somebody you ask on the phone and
Exactly, that's how the industry operates, but with these things, where the TPOs have a lot of more information, you have to advise them on creating documentation to safeguard them from a tax addition at a later date.
there is a website that gives gold prices on hourly
Twice a day.
So probably in a volatile situation, you may look at maybe the same time or same. I mean, you cannot definitely have same time, but what is the time that you did your transaction? How will the AO prove what time? When you say hourly, the data changes. You did the transaction in the morning or the evening. So I mean, it's difficult for AO also. It's not easy for AO to pick your case and make holes in that. It will be difficult for him also. So probably looking at averaging, if the fluctuations are not something very significant or huge, or the trend is changing completely, then averaging may help in such cases. Now when I was saying the time travel power, this was what I was referring to. If your transaction is done during the year April 13 to March 14, they have almost 4 years to conclude their analysis whether the transaction was at arm's length or not. Is this really contemporaneous exercise? So, a lot of, in some countries there is a very interesting concept of the transfer pricing assessments have to be held immediately in the assessment year. Some countries do follow that concept, not as part of your tax assessment, but as a separate assessment. Lot of them have said that if your transfer pricing is not challenged, then it is accepted. So, including in India, so unless it is challenged, it is accepted. So, there the timelines are very short, and you are not bound to have huge amount of data coming in the subsequent period. But here, when they have almost 4 years, the industry has changed. Just to give you an example, of late, what is being challenged is the share valuation. When a company does a share valuation, it maybe basis some future projections using DCF. Now, when I'm doing DCF, say I was doing DCF in 2008, when the industry was booming, my projections were excellent. When actually the audit happens 4 years down the line, the boom has gone down. Effectively, I mean, there was a dot-com bubble which burst, and suddenly everybody in huge mess, including me. What happens? I use the projections to deal with this, but my actuals did not match up. So assessing officer does a valuation using the actuals. Is he justified? So a lot of these things happen. When we talk of share valuation, yes, when we are using DCF, there is a point to argue that this was done at that point in time. You can't use the subsequent data to disprove that. But a lot of times this check needs to be kept that are we underplaying or overplaying these DCF? Are these real? So when you carry out a valuation exercise, keep these in mind, and guiding principles that the valuation documentation is also a TP documentation and will be of help to you at a later date. So when projections, understand the basis, validate the basis, don't just accept it. And make it a good document so that you can place it before the TPO to argue at a later date. whether it is a transaction or not, that is still being fought, that when the share valuation was different, as in the case of share, whether there could be a primary adjustment to the share price itself. Secondary adjustment will be debated and discussed maybe in the next round of litigations. Why transfer pricing documentation? To save on the penalties. 271(1)(c) for transfer pricing is very typical, because any adjustment pursuant to a transfer pricing audit is considered as deemed concealment. So unlike others where the onus is on the AO to prove that you concealed the income, which they simply do it by issuing a show cause to say why you were saying that. But here the law itself says that if an adjustment is made, so much is deemed to be concealed unless the tax officer or the taxpayer is able to demonstrate that the transfer pricing was charged, paid or fixed, determined in good faith and with due diligence. So this is what will help you save penalties of the documentation that you created while you entered into an agreement or while you fixed the price. This is these penalties are something like marriages. If you don't do sufficient due diligence, you are going to face it. I don't know, even after doing due diligence, how many of us were saved. Okay. 271AA, 271G, very important. A lot of transactions or clients come to you and say that, क्या है इसमें transfer pricing? Am I required to maintain documentation? We will do it. Not required. ठीक है, देखा जाएगा. But the penalties are rigorous. 4%, 2% for not maintaining documentation and 2% for not furnishing documentation. If you not maintain, how will you furnish? And failure to furnish 3CB 1 lakh. Coming to benchmarking analysis.
One small point in terms of the penalty.
Yeah.
Like as of today, so much right line test they are using. They are saying that if you are doing certain E&P expenses and you have not done on benchmarking, so many times it has been seen by the Indian companies who are promoting the foreign brands. They are not reporting, they are not treating the E&P expenses at all as international transaction, and they don't report it. During the course of a TP audit, the TPO find that the expenditure which has been made by the Indian company on a foreign brand is excessive in terms of the other EU companies. Now, in such a scenario, can TPO, after making certain adjustment also, can, using the bright line test, can say that you have not reported and I will initiate a penalty for non-reporting. Is it they can do so?
See, interesting. Number one, when we say EMP, the question is this an international transaction? What is an international transaction? When I am rendering any service to my aid, it is an international transaction, not that when I am paying or receiving. So, what is it that the AO is saying you are doing? The AO is saying that you are rendering the service of promoting the international brand in India. That is the international transaction. Whether you are receiving money for it or no is the consideration part. So there is a transaction, arm's length price of which is a separate issue, but there is a transaction that you carried out at value 0. Why did you not report that transaction? That's what AO's argument is. And all of us know that AMP has been upheld and is now the fact that we need to all, when we are assessing or advising our clients, do this test and find out whether there is any issue on this or no. Although maybe at later date taking a lenient view because the law was not clear till the time these decisions were there. Maybe penalty may not be levied, saying that the law was unclear, whether this is a transaction or not, and a lot of defenses would come up. But once sense is prevailing that AMP is an expense and companies have begun reporting it, it will be difficult for you to salvage yourself from a penalty at a later date saying that I did not. So maybe for earlier years you still have some validity, some point that I never imagined this to be an issue, or this was never the intention. So here again your intention, the bona fides and all would need to be proved that when incurring these expenses, these were our objectives and not these, and this adjustment is, maybe you could challenge it till the highest of authorities. But now the time is that you have to advise your clients considering the bright line test.
TPO may initiate the penalty proceedings for non-reporting the
Typically, yes, they would initiate, that is goes without question. So, by default, it is said that when an adjustment is made under transfer pricing, by default, 271 months is said to be deemed concealment. So they will definitely initiate it. So that goes without question. But
would you like to throw some light on, I find that AMP expenses, some selling expenses also, like we chartered accountant are also adding in AMP. Did selling expenses not a part of the?
Sir, I think in 271G, 271 AA, it says failure to maintain documentation. So maintain would typically mean maintaining in hard copies. Is it sufficient that if you maintain documents in soft copies, that would sufficient?
what really documentation does not mean maintaining in hard copies. It is the rule 10D documentation. Do you really have maintained the documentation prescribed in 10D? So it is not necessary that it has to be in a particular form, maybe physical or soft. It is documentation or information.
When you're talking of invoices and all that has to be either in a...
in fact, in a lot of countries, the invoices are generally working electronically only. So where is the question of, law does not say that you need these documents to be physical and inside. Maybe you could print it out later, and a lot of things also work on emails. So do you mean that I have to keep a print of these emails like management services? Typically rendered via email. Or maybe person comes in where there is no information. So what is it that we are talking about documentation over here? Maybe minutes. So these are various things. So I don't see that the law says that the documentation has to be hard copy or printed. Even soft documentation, information, emails, industry data, this is all documentation. So to your question, I think we'll discuss it offline maybe, and there are other people who are going to take up these topics subsequently. So you'll learn at greater depth with them.
Just one question. In case of voluminous transaction, sometimes you have like transactions which go into crores of rupees. Okay? So that time the client is reluctant to give you a large set of the invoices. So in such a case, what is the right percentage of the invoices that you should maintain for documentation purposes?
I think when the TPO says documentation, he could ask you for 100% of documentation. So there is nothing that is prescribed that this much documentation is sufficient. Maybe you as an auditor, you need to use your judgment to have your test data. What is the data that you are going to test? What is it that you are going to maintain because you have relied on these documents to produce your certificate? That probably we should use the auditing principles prescribed by the institute, the guidance.
So in case if I maintain around say 70% of the sample invoices for my client, so in that case, is he eligible to revise the penalty for me for not maintaining?
Sorry?
If I maintain only 70% of the invoices, the client maintains as documentation during the audit. So for the 30% which we have not maintained, Can the TPO levy the penalty of 2%?
You have to maintain documentation for every rupee of international transaction. Law does not exempt you, or rather the law says in fact that if the transactions are below 1 crore, you could deal with not maintaining the documentation.
Yeah, that's fine.
But once your transactions cross 1 crore, you have to maintain documentation for every rupee.
So in that case, sample invoices doesn't really work.
See, generally I have not come across a situation where client does not have documentation, something like as simple as invoicing or maybe agreements or such transactional documents. Maybe a situation could be that due to some loss, like say for example, as he said, soft data is sufficient. Maybe soft data was maintained and it got lost. In such cases, these are exceptional circumstances and to be dealt with and explained.
Yeah.
But I think in a genuine case where you should have maintained documentation, there is no excuse, or I would say the TPO would have all right to say that why for 30% of transactions you don't have data. They don't ask you for 100% of invoices in the first place in voluminous
Yeah,
cases.
yeah, exactly. It goes more than 500 crores, you possibly don't have.
But the law doesn't give you any exemption. What is the importance of benchmarking analysis? We just discussed Rule 10D, which necessitates you to maintain documentation, and it forms part of the transparency documentation, which is the first line of defense for the taxpayer. Your transparency documentation is the first line of defense. Then you could build up other lines of defense and arguments using other data and information to prove your points. What is the purpose of benchmarking? To identify comparable transactions that are further used to assess whether the international transactions under review comply with the arm's length principle or no. So, benchmarking is one part of the documentation and it is used to determine whether the transactions are at arm's length or no. As per Rule 10b2, comparability of international transactions shall be judged with reference to 1. Specific characteristics of the transactions, 2. FAR analysis, and 3. The terms and conditions of the transactions and as prevailing in the market. So what are the terms and conditions of the transaction and what are the terms and conditions generally prevailing in the market. So these are the guidances for the comparability. The OECD has recommended a 9-step process for benchmarking analysis, where you first identify the years to be covered, 1 year, 2 years, 3 years. So OECD does recommend use of multiple year data where it affects determination of pricing. Analysis of the taxpayer circumstances, understanding of the control transaction based on FAR analysis, review of internal comparables if available, identifying sources for external comparables if available, selection of the most appropriate method in the PLI, identification of potential comparable, determination of and making comparability adjustments, and finally interpretation and use of data collected for determination of ALP. So this is a very summarized slide of this. OECD has expanded and enumerated on each of these steps on how do you do it, what should be done at each stage. So I recommend all of you to at least go through the OECD guidelines on documentation. Typically, what does a transfer pricing study or a benchmarking analysis, as we call it, contain? It contains a summary or gist or brief of the group and the taxpayer, the international transactions, the FAR analysis. So, has FAR analysis been discussed or the importance of FAR been discussed in the earlier lecture?
Yeah.
I'm sure I don't need to delve more with that. Has it also been discussed what is the importance of industry overview, and when it says that you need to maintain data or information about industry, the industry reports. How many of us actually use the industry information while doing a benchmarking analysis? Great. So I'm sure if you could share your experience on what you did and how you did and how it was relevant to the case. Maybe it will be good help.
Yeah, it was relating to genuine jewelry industry.
Right.
So it was basically the various trends which are going on in the genuine jewelry industry since last 20 to 25 years, and how.
And what sort of transactions are being entered into by each and every companies which are into the general jewelry industry? How the DT means whether those companies are DTC registered, means they are the holders of our DTC diamond trade. Then further to that, it was also being given a general understanding that credit periods are not being credit periods are not being prevailing in the general jewelry industries. And besides that, it also says that generally the interest is not being levied when a particular amount has been outstanding or the accounts have been receivable. So this kind of industry analysis are being helpful at the time of benchmarking any transactions.
Very good. Each client is generally part of some industry, and industry has some trends, some specific characteristics. Like we said, in the gem and jewelry industry, the credit periods are not being adhered to, or credit periods are huge. So this will help you either benchmark or equalize or make adjustment to your case, whether it is in line with the industry or no. So there are a lot of industry reports available on various things or various parts. So how are you placed in the industry? What is the other industry doing? Whether you are really following the other industry, or is this really affecting your pricing? Like industry is in a particular life cycle. Where are you in that life cycle? Your pricing really depends on that. In case of a technology industry, penetrative pricing, maybe in year 1, year 2, year 3 you have losses. So industry reports would probably segment or provide data or information. These are the new entrants. When you look at their data, probably they are as good or maybe worse than you.
Even that industry itself says that one diamond is not at all comparable with the another diamond, because it has got a various cuts, it has got a various dimensions, it has got a various specifications. So I cannot judge the comparability of my transaction with the comparability of my other comparable companies, because in many times it happens that I cannot like say for any purchase or sales transaction or import or export transaction, I won't be able to benchmark with the help of a cup. So it has been specifically and it has been expressly mentioned that one diamond or one jewelry or a particular rough cut, etc., could not have been compared or judged with the help of another diamond or rough cut.
Exactly. And especially
really
something like beauty lies in the eyes of beholder. To a particular lady, diamond may be of a different value compared to another lady.
Yeah. And so in that kind of a situation, cups I don't think cups is a favorable method.
I mean, it all depends on particularness of each transaction and what kind of cups you are using. So it's all really very, very distinct in each case. So industry overview we just discussed. Selection of tested party. Has the concept of tested party been discussed? So what is a tested party? Tested party is the party, one party of the transaction, whose profits we are benchmarking. So there are some golden rules of how to select a tested party. Somebody whose functions, assets and risks are not complex, does not use significant intangibles, is more simpler entity, whose data can be easily benchmarked without significant adjustments. So these are few things. So tested party could be either the assessee or the AE. There is no restriction under the Indian law that the AE cannot be used as a tested party. So initially, yes please, Chapagar.
Initially they had that view that
Yes, initially they did develop that view and they made adjustments that you cannot use AE as a tested party. And they were able to defend those also in the cases where the assessees were not able